Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So we all know the housing market continues to turn in the buyer's favor. And what we are seeing is a lot of people are deciding that they want to buy condominiums instead of townhomes or single family homes. So if you're interested in a condominium and you want to know the pros and the cons, stick around. In this video, I'm going to show you all the tips. So we all know the housing market is continually getting stronger in the buyer's favor. Buyers have more opportunity than ever, and a lot of people are starting to choose condominiums. Remember, when you're buying a property, you have the choice of getting a single family home, a townhome, or a condominium. Now, condominiums are great, but today I'm going to discuss a lot of detail about condos, pros and cons, things you know, things you probably don't know, and things you want to know. So let's talk about pro number one when buying a condominium. So condominiums historically are a little bit cheaper than single family homes or townhomes. They also have less maintenance. Traditionally, when you buy a condominium, they're usually part of a homeowners association. There are dues and fees associated with that, but they take care of all the upkeep, they take care of the landscaping, and sometimes those HOA dues even include homeowners insurance. So it can be less maintenance for the buyer, and it can be cheaper for the buyer. Some downsides to condominiums is that they're attached units. They're attached to a lot of other people, so you don't have the freedom of a single family. You don't have your own yard. There could be a lot of noise and a lot of chaos amongst the project. So you got to be mindful of all these things. But even if a condominium ends up being the right fit for you, based on your lifestyle, what I want to talk about a little bit more in detail today are the mortgage guidelines behind buying a condo. Because when you buy a single family home or you buy a townhome, mortgage companies only care about the value of the property and the condition of the property. When you buy a condominium, they care about the quality of the condominium project as a whole. And this can be a deal breaker for a lot of folks out there that aren't aware of this. There are different rules for different types of home loans. So conventional loans have a rule, FHA loans have a rule, and VA loans have a rule. And I'm going to get into all those here in a sec. But again, when buying a condominium versus a single family home or a townhome, even if you, the buyer, is great, even if the condominium unit that you're buying is great, we want to look behind the scenes at the entire condominium project to make sure it's all good. So let's get into that. When you buy a condominium, if you are getting a conventional loan or an FHA loan or a VA loan, the lender wants to know what's going on with the entire project. So doing a conventional loan, they call it warrantability. Is the condo warrantable? So what happens is, buyers are not always fully aware of what's going on with the condominium project. You may have 20, 40, 80, 100 people all joined together in one project. And so, even if the buyer is in a great position, we want to make sure there's nothing going on with the condo project that you guys aren't aware of that could potentially cause issues later on in the future for you with value, with resale and all that stuff. So lenders by nature have to send the HOA what's called a condo questionnaire. It's like a 40-page questionnaire, and they have to answer all these questions. Basically, if any of those questions are issues with the entire project, then you can't get traditional conventional financing on it. Now, I want to go through a couple big ticket items that are on that questionnaire that we pay attention to the most. I would say 35 of the questions on the questionnaire are real minor ones, and no one ever answers them no, and so they're not an issue. But there are 4 of them that I want you to pay attention to if you're considering a condo, because we have to find this information out as fast as we can once you get under contract. Sometimes we can find out beforehand so you don't waste your time, but if we can't, we got to go to the HOA, get the questionnaire filled out, and get all those questions answered. But the 4 big ones that we look for up front are, number 1, are there more owner-occupied units than rentals? We want to see at least 51% owner-occupied. Why? Well, by nature and by design, people that own their own properties take much better care of their properties than renters. So if you've got a condo project that's full of renters, sometimes they tear up the property, they don't take great care of it, and obviously there can be a decline in value over a period of time. So number 1 is we're checking to make sure at least 51% of the people that occupy the entire condo project are owners. That's number 1. Number 2, we want to make sure that no single person or no single business entity owns more than 20% of the units. So let's say you're buying a condo in a condo project and there's 100 units in the project. No single entity or no single person can own more than 20% of the units. People say, well, why does that matter? Well, we want to make sure, really for 2 or 3 major reasons. One, if one person or one business entity owns more than 20 condos, and let's say they're all mortgaged or have financing on them, and let's say that person has a heart attack, or that person has a financial hardship and they can't make the payments on all those condos. Same concept with the business entity. So when you've got one person or one entity that has, such a strong leverage position within a condo project and they own more than 20% of the units, everybody around there is tied to them. And so if they have any financial problems and they default on the home loans and all those condos, potentially go into default or foreclosure, it can really drag down the project overall and it can pull the value down. So we want to make sure that that's not the position whenever you're buying in there. The other reason why we don't want people to have more than 20% of the units in a specific project is because the voting rights. HOAs have boards and they vote on things, and everybody tries to have an equal vote to try to keep things balanced throughout all the homeowners and through the project. But if one person owns 20% of the units and they're on the board, that person gets 20% of the votes. And in theory, they could vote everything in their way to favor them, and that's not what we want. So we got to make sure that at least one person or one entity doesn't control or own more than 20% of the project. Number 3, so every condo project that has an HOA has a budget, just like you and I have a budget. Money that you take in, money that you send out. And that's a debit and credit type thing with an HOA. So we have to check to make sure that the HOA budget has at least a 10% reserve in its account. So it's very similar to like a human being. A mortgage company wouldn't want to loan money to somebody that didn't have a little cushion in their bank account after they close, because obviously they need that money for survival and for certain things. Then the last thing we want is somebody to go empty on their reserves. It can cause default and issues. So the same concept applies to the condo project. We say, hey, who's ever running the HOA over here, who's ever in charge, whoever the treasurer is, we need to look at your budget to make sure you've got at least 10% reserves. So depending upon how much they collect every single year, how much their debts are, we want to make sure that there's at least 10% left over. And that matters because if they don't run a good budget and they don't have good reserves and they run out of money, what happens is that you, the homeowner, potentially will get a special assessment. Now, if you're not familiar with what a special assessment is, it says, hey, right now the HOA dues are $200 a month for every owner. However, if we as the HOA run out of money, we can go give everybody that's an owner a special assessment, and we can reassess their monthly HOA dues, and we can increase them to get our budget back in line and get back to a positive and a surplus. Well, if you're a person that has a $200 a month HOA, and they try to do a special assessment because they are out of or low on reserves, and they try to increase your HOA fees from $200 to $350, that could cause a financial problem. That could cause you, the buyer, to potentially default because you can't afford the extra $150 a month. So again, we don't want to put anybody at risk. We want to make sure that the loans perform, and we want to make sure that everything's all good. But if you're buying into a condo project and the HOA is really low on reserves and they have the legal right per the bylaws to go do a special assessment to all the homeowners that are in that community, and they raise those monthly fees by $100, $200, $300 to make up for the bad HOA budgeting, that falls back on the buyer. And it can really cause some strain later on in the future. So that's one of the reasons that we look at all that stuff, to make sure to protect our investment, but also to protect your investment. And the last major one that we look at is HOA litigation. So when you have condo projects, more times than not, there's legal drama. When there's legal drama, it can be a lot of different things. It can be major, it can be minor, it can be a slip and fall by the pool, it can be a construction defect, it could be something in the parking lot, you never know. But we as lenders, when we get the questionnaire filled out, or we ask these questions up front, Lenders do not want to do loans on condominiums when they've got pending HOA litigation. The reason behind that is the litigation has not been completed yet. We don't know who the responsible parties are. We don't know who's going to pay everything in full. It can really mess with, the liquidity position of the condo project and the HOAs. It can really mess with the insurance as well. If somebody gets sued, of course the insurance is going to pay for it, but obviously the insurance premiums are going to increase after the fact. And so, the issue is majority of the time, and I say majority because there are exceptions to the rule, but they're very, very, very minimal. If a condo project is going through litigation, lenders will not loan on that project. Now, again, that's on a conventional loan. On a traditional loan, there are exceptions to the rule. There's what's called non-warrantable projects, where other private institutions in Dallas that we work with will loan on those projects that have too many renters, or one person owns 50% of the units, or there's litigation or bad reserves, except those private investors want to do a minimum of 20% down. So majority of the buyers out there don't want to do that on condos. So just want to drive a little clarity around that. Now, if you're not getting a conventional loan and you want to buy a condominium, it gets a little easier to discover if all these problems are already going on in the condo, right? Because on a conventional loan, there's no real way to discover what's going on with that project unless you get everything done up front with the HOA company. Now, you can ask the realtors in the area, you can look at some sold comps in the area, and so of course, if there's a lot of mainstream comps and mainstream financing, the indicator is everything's probably okay, but there's no guaranteed box that you can check. You just have to do your due diligence up front and then do as much as you can after the fact. And the reason why we try to do it so quickly is because we don't want to put somebody through escrow and paperwork with the loan and order the appraisal, and then 7 to 10 days that condo questionnaire come back and there's issues on there, and we either have to try to overcome it if we can, but if not, sometimes they have to stop, cancel the contract, and start over. So the more we can do up front on those conventional condos, the better. Now, again, back to if you're an FHA buyer and a VA buyer. So the easier thing on condos on these is there's actually 2 websites that you can go to, the HUD.gov website and the VA website. So these 2 type of loan products, FHA and VA, will lend on condos as well, and they actually have online websites that have approved condo projects in them. So it makes it a little bit easier up front for you, the buyer, and your agent to figure out, hey, my client's FHA approved, they want to buy this condo. How do we know if this condo is FHA approved? So the rules on those FHA condos and the VA condos are different. You don't have to go through, all the HOA questionnaire and stuff. It's not quite as layered and difficult as the conventional loan. FHA has a website. So literally the buyer and the agent or myself can go to the website. You type in the specific condominium project and you can find out one of 3 things. If the condominium project is on the FHA approved list, it will have a green check mark by it, and that means it's approved, and that means that buyer can get FHA financing because that condo is FHA approved. If that condominium name is on the list and there's a red X by it, unfortunately they can't get FHA financing on that condo, and here's the reason why. It means at one point in time that condominium was approved for FHA, but it expired and the HOA never resubmitted their documents back to HUD to make sure that that condo is still FHA approved. And so what happens is if they don't renew their policy and renew all the details with HUD, then it expires. So sometimes you'll pull it up on that HUD website and the condo will be listed, but it has a red X by it. So they can't get financing on that condo right away. The HOA would have to submit the paperwork back to HUD. HUD would have to approve it, get it back to like a green check mark or a positive, and then they could get FHA financing on it, but that website dictates if they can or they can't. Now, what happens if you go onto the website and the condominium is not on there at all? There's no green check mark, there's no red X. What do? Well, if it's not on there at all, it means it was never approved. So you can't get FHA financing on that condo either. Now, there are opportunities when condominium projects have either expired and or have never been on there. You can submit paperwork back to HUD and they can do their due diligence. It takes probably about a month, and they'll send one of their consultants out there to see if the project meets the requirements. And if it does, they put it on the approved list and people can get financing specific to FHA in the future. But there's a cost to do that. It's upfront to the buyer. It's non-refundable. There's no guarantee that they would approve the project, but at least it gives you the opportunity. So the same concept applies to VA for veterans. So when veterans are shopping for homes, they don't have to buy a single family. They can buy a townhome, they can buy a condo. But the VA rules are very, very similar to FHA, which is if a veteran wants to buy a condo, it has to be on the VA website. So you go to the VA website, you do the same thing as the FHA and you look it up. If it's on there, you're all good. If it's not, you can't do it. So these are some rules around condos. They're very, very specific. They're very, very layered. The reason that I wanted to do this video with everybody about condominiums is because they're getting more popular, especially with price and maintenance and demand and everything in Dallas. But a lot of folks out there, whether you're an agent or a buyer, you don't know all these specific rules about condominiums that are underneath the surface. And so too many times I see people get under contract on a condominium and they don't know all these rules. And then myself or our team has to do all this additional mortgage paperwork in the first week or two, and it ends up finding out that, hey, this condo is not warrantable. You can't go conventional. This condo is not FHA approved. This condo is not VA approved. And what happens is they have to terminate the contract and they have to back out and start again. So the more that I can give people this information up front that, hey, condos have extra layers, they're harder to get. The more we do up front, the more it will eliminate all the risk and the easier it will make you, to close on the back end. But however, if there is going to be drama up front with the condo project and it's not warrantable, it's not on the websites, you might as well go ahead and pass on it, because the last thing you want to do is waste your time and waste everybody else's time with a condo project that isn't eligible for conventional FHA or VA. So listen, hopefully you found this condo video extremely helpful. If you did, like, subscribe, comment, share with somebody that you know that needs this information. If you got any questions, want to set up a financial consultation, talk a little bit about your home loan position and the future of your home loan, give me a call. Always here to help. Until next time, stay tuned.